Welcome to Coffee Regs, a CSS RegTech podcast series on moving from a tactical to strategic approach to regulatory compliance.
Hi, this is Natalie Silverman for CSS. Welcome to our next episode of Coffee Regs. On today's episode, we're discussing one of the hottest topics right now, digital assets and cryptocurrency. Are they considered securities? What does the SEC's risk alert mean for digital assets? And how should investment managers be thinking about cryptocurrency trading and compliance? Please welcome CSS's Director of Registered Investment Company Services, Allison Fraser, and Director of Broker-Dealer Services and Private Funds, John Gentile. Good morning, Allison and John, and thanks for sitting down for Coffee Regs.
Thanks, Natalie. Looking forward to talking to John about cryptocurrency and digital assets. Because as we know, this area has just exploded in the past few years. I think there are more and more investors from retail to institutional to private funds who want exposure in their portfolios to these types of assets. It's also a great opportunity, I think, for investment advisors and broker-dealers to expand their business offerings and to be able to offer their clients new opportunities to invest in different types of assets and strategies that previously were not in their portfolio. Also, I guess in February of this year, John, the SEC issued a risk alert on the Division of Examination's continued focus on digital asset securities. The alert, among other things, noted that particular digital assets may or may not be defined as a security under the federal securities laws currently. I think it would be helpful then for us to frame our discussion of digital assets by first describing what digital assets are securities and those that are not. What are your thoughts?
Allison, that's a great question. It comes up all the time because we have this category, digital assets. Well, you think of Bitcoin, cryptocurrencies, which typically are not securities. The SEC has sort of informally come out and said that. Former Chairman Jay Clayton, that was his view. And I have come across it in some correspondence with some investment companies that were trying to get registered to invest in cryptocurrencies. And they cited the Howey test, which really, it's a Supreme Court case. They spelled out certain elements. If you meet those elements, investment contract could be deemed a security. You can go ahead and look that up. If you don't meet those elements, generally not a security. And it's basically, really, really quick. Are you investing your money into a company, a common enterprise, where through the efforts of others, you'll be generating a profit with investments at risk? It's kind of the way they look at it. That's the 5,000-foot version. And again, Bitcoin, probably not, but there's so many other digital assets. And I just found an article online just a few weeks ago. Chairman Gensler said that he was talking about stablecoin. He said cryptocurrencies whose prices depend on more traditional securities might fall under the securities laws. Okay. So, and that's where I think the SEC may be investigating some of these exchanges that are trading stablecoin, but there's also initial coin offerings. The SEC has some info on a couple of its web pages, might very well be securities when they're issued by private companies. And then, of course, you have non-fungible tokens. So it's really, what are you trading? What are you buying? What bucket does it fit into? And as you pointed out, look, everyone's jumping on this bandwagon, retail, institutional, but it's an evolving topic. Allison, just about every week in the financial media, the Wall Street Journal, there's something on digital assets, whether it's from a regulatory perspective. Many of the major investment banks have made quite a bit of investment in this space. So it's here to stay. It's only going to grow.
That's exactly right. This is not an asset class that's going away or a strategy that's going away. And I think from that perspective, it's incumbent upon compliance officers and compliance teams to get their arms around fitting a round peg in a square hole, if you will, since the regulatory requirements around these particular types of assets is evolving and is not as specific as we would hope it would be to make it easy to write a policy or a procedure or tell somebody what to do. There was some guidance also, John, in the risk alert where the Division of Examinations kind of made clear what they're going to focus on with respect to regulatory compliance. And I think it would be helpful to some of our listeners to talk about some of these focus areas and give compliance officers who are just being asked to consider this asset class in their compliance program what the SEC has identified as to consider and what you and I have discovered through working with firms that have these types of assets, what we've had to grapple with sort of thing. One of the things that I found in the risk alert that just neon sign was disclosure, disclosure, disclosure. What are the key considerations for disclosure when you're talking about cryptocurrencies and digital assets?
Sure. That's another great question. Look, the SEC put out this risk alert. When they come on site and do an inspection, they're going to apply the Investment Advisors Act to your firm. And they're going to start with the questions we just handled. Are they securities? Are they cryptocurrencies? Not securities? But they're going to look at this asset class within their framework, within their perspective. And as we know, with respect to disclosures, paramount concern is Form ADV, in particular the 2A, where you have to talk about investing, you have to talk about the risks of investing. They're certainly going to go and look at how you're trading some of these securities. Now, some of them may be certainly public securities that you trade through the NASDAQ or a market maker, over the counter, or what have you. Some may be offered in private placements. So you really need to get your arms around, okay, we've decided it is a security. Here's how the Investment Advisors Act fits in. Of course, you have disclosures, conflicts of interest, fees, expenses. How do you value some of these securities? So all the traditional areas of concern. And if you're managing a private fund, and as you alluded to earlier, I'm a CCO of a private fund that invests in digital securities and digital assets, not securities. Go look at the private fund risk alert that the SEC issued in June of last year. You have to be able to address all those different issues on investment allocation, fees and expenses. So again, when they come in, and sure, you talk about these are the digital assets that we're investing in, these are securities, these aren't, but here's how we're applying the regulatory framework. And of course, don't forget how you're marketing your investment advisory services to clients involving digital assets. And Allison, you and I have seen where you have entities that are set up, they might manage digital assets, non-securities, in an affiliate away from the advisor or away from the broker dealer. So you kind of have to get your arms around all these different issues. It's a moving target, and it is a target. There's just no way around it. As you pointed out, there's a risk alert. And Chairman Gensler has a background in digital assets and cryptocurrencies. So I think he has a particular interest. And I think they will be looking at some of these exchanges. Are they trading initial coin offerings, providing custodial services and so on, stable coin? And if they are, there are going to be some cases these entities have to get registered as broker dealers. And I know we'll get into that a little bit later when we talk about custody. But yeah, it's a work in progress. But just as we're getting at, just apply the existing regulatory scheme and put yourself in the shoes of an SEC examiner. What he or she going to be looking at, and be ready to kind of translate from the crypto space into the advisory space.
I think those are really good points, John. And I also would just stress too that from my experience in working with firms that are managing these types of assets, risk disclosure is key. There are so many knowns and unknowns about the technology, and creating that environment where your clients understand the associated risks, because we're not just talking about simply an investment strategy. We're talking about an investment strategy that relies very heavily on technology. So in addition to some of the complexity of those products, there's also the technology risks. Are you more susceptible to hacking? What happens if you have hot and cold wallets? What happens if, you lose your information and you can't get your password? It's gone. Those are really, really, I think, very different types of risks that needs to be addressed in your disclosure, along with whether the liquidity of the products, because some of them are very illiquid right now. Others have much more liquidity.
Absolutely. Because when we talk about cryptocurrencies, we talk about Bitcoin generally, which is the largest, Ethereum, but there are over 4,000 cryptocurrencies. So you're right, there may be little or no market. And that day comes when you want to sell. And certainly the infrastructure that broker dealers and advisors and custodians and clearing agencies, SIPC, and you have this sense of security, regs that stem back to the Great Depression when the SEC was formed. But that's all changed. And we've seen that these exchanges can be hacked. Your Bitcoin can be stolen and it's gone. It's like you can complain to you may complain to a regular.
Complain all you want, but nobody can get it. It's not like it's insured.
It happened in Japan, Mount God.
Yeah, exactly.
So that's a great point that you bring up. It is not it's not the traditional infrastructure.
This is where that team approach to compliance and disclosure is where compliance is everyone's responsibility, really comes in as you're starting to work with a new product offering. You need to talk to your investment team that understands and knows the products and can help you identify the risks and walk you through. Maybe it's the operations folks who are going to walk you through how something is traded. Maybe you have a separate risk team and work with your marketing team on what you can and cannot say as an organization, just so you understand how the whole blockchain technology works, how the instruments are traded. Are you trading through a product sponsored by a third party? Are you trading directly for client accounts? You need to understand the product and what your offering is in order to be able to disclose accurately and completely the risks and how they're being managed or mitigated by your firm. One of the other areas, John, too, that you just alluded to is custody. I mean, we all know sometimes we feel like the custody rule for investment advisors can be a little bit as clear as mud or more complex than we would really like. It doesn't get any easier with digital assets and cryptocurrency. There are a lot of things you need to consider. Can you talk to us about what we should consider and where some of the pitfalls might be?
Sure. Well, the regulators are moving slowly to provide some guidance. Okay, last year in June 2020, the banking regulator, the OCC, came out with guidance and said federally chartered banks and thrifts can provide custodial services for crypto assets. Step in the right direction. And of course, banks are considered as qualified custodians under the SEC's custody rule. So that's big. And a number of these exchanges have become or are in the process of becoming regulated. So that's a step in the right direction. The SEC in December of last year came out with some guidance and said, look, for special purpose broker dealers, and those are broker dealers only in the digital asset security space, you can provide custodial services for digital asset securities. Okay. So the regulators are very slowly moving in that direction because, as you alluded to, just custody rule in general, how many FAQs are? I mean, every time I look at custody firm, I'm flipping through the FAQs. Well, how's this wire working and this and that? So you really have to get your arms around what kind of technology is in place to protect your clients' investments. Now, if they're securities, sure, they're going to be going through the traditional custodial route, perhaps their private placements, and that's fine. But if you're talking cryptocurrencies, as you mentioned, is it hot or cold storage? Cold storage is the safest. There's no online access. Internet connections, sure, are available for hot wallets. And then there's vault storage, which was sort of a combination of both. But if you're in compliance and operations, and in my case, I'm relying on the folks in operations and finance to explain all these concepts to me because some assets of the fund are being protected in that regard. So you really have to make sure you're doing business with an exchange that has top-notch technology, okay? Because, again, if you're in the private fund space and your exchange is hacked, you're done. Your Bitcoin is gone, and that's an asset. Could be a material asset of the fund. So you really need to understand that. And in my case, I work with some really, really knowledgeable, capable people who've explained all this to me, and it's really something that I've had to come up to speed on. And really, really interesting area. So be ready for the custody questions. Again, and some of that goes back to: is it a security? Isn't it a security? Be able to have someone at your firm to speak to the technology. And again, I wouldn't be surprised if we see more firms set up as affiliates of advisors and brokers to keep some of the cryptocurrency related investments completely separate. That'll be an interesting situation and development to see if that's what really takes hold.
I think the evolution of the custody rule to these types of assets is really something that takes a lot of understanding and delving into exactly what these products are. Again, it goes back to understanding how they're traded, where they're warehoused, and what have you. But I do think it's also as part of the evolution of the regulators, whether it be here in the US or globally. I think all of the regulators are grappling with how best to address this and what requirements to put on registrants. So we've talked about kind of from the compliance perspective, what a compliance officer may need to consider or should consider. From a portfolio management perspective of digital assets, what about what your investment team needs to consider or your research team needs to consider with respect to portfolio management? I would think you would start with even just classifying what these assets are. Are they securities? Aren't they? And determining what your process needs to be around them. The risk alert spoke to some things, but what are your thoughts on it?
I agree. Are you dealing with a security or an investment that's not a security? And I think that's important. But in both cases, you're going to have an advisor, an investment officer making investment decisions on assets for clients, whether it's for private funds or institutional or retail or what have you. So what's step one? Do you understand the risks? What kind of due diligence are you doing? And this speaks to some of the things we've just been talking about. Where do these products trade? What's the liquidity? We saw what happened to the price of Bitcoin. It plummeted from mid 60s down to the low 30s. And, there are instances where the stock market dropped several hundred points as it did recently, and Bitcoin dropped. I would think that maybe the opposite would have happened. Bitcoin would have gone higher. So you really need to understand what you're investing in, how it trades, custody, the risks involved. Do you want to hedge some of your risk if you're long Bitcoin or what have you? Because there are derivatives on these different types of cryptocurrencies. But Allison, you raise a good point. It's an investment. And at the end of the day, one of your clients or an investor in your advisor or a regulator can ask, well, why did you invest in XYZ? And you better be able to pull out the due diligence files that address all these different issues and be able to understand them and explain them. And as someone who's been in the industry for many years with a securities background, it's a challenge to understand the technology and the different terms and jargon that are thrown around. But at the end of the day, you're buying, selling an asset and all these different issues that we talk about risk, liquidity, pricing, settlement, custody. They apply one way or another. They apply. And you don't want to find out the hard way in an exchange that's hacked. So doing due diligence on where you're trading and where you're custodying your Bitcoin or other cryptocurrencies is very, very important.
And I think an extension of that due diligence, John, is maybe you're managing the assets or offering the opportunity to invest in digital assets through another product or a third-party platform. There, the due diligence is equally as important. You need to know who your partners are and who you are going to be recommending to your client to do business with, because it may require a separate investment management agreement or a tri-party agreement of some sort. But like using any service provider, you can't just say, well, it's one and done. We did our due diligence when we started offering the product. It's something that's an ongoing responsibility of, knowing if they've had any issues with trading an account in digital assets, or if they've had problems with personnel, or if they've been hacked. You really have to stay on top of that. And, it's an important part of the investment process if you're going to offer it through a third-party platform.
I totally agree.
Moving away from the risk alert, but an area that's come up, I know for both you and me in talking to our clients, that I think it's, worth mentioning here is personal trading. We've just talked about some of these assets are securities, some of them are not securities. What do you do from a personal trading monitoring perspective as an advisor? Do you require clearance? Are they reportable? Do they go on restricted lists? You may or may not get statements. What do you do?
These questions started coming up about 2 or 3, maybe 3 years ago, and we all agreed, but they're not securities. Your code of ethics clearly is focused on securities transactions. So I don't want to hear about any of the trades. Forget about the statements. There is a school of thought that makes sense for if you're out there and you're recommending ETFs and mutual funds, stocks, fix it. Okay. And I'm still okay with that. But I think you have to look at your business model. Where I'm at, I'm the CCO of a private fund that trades in cryptocurrencies and assets. And we're very, very careful, very conservative. Essentially, we're saying that there may be pre-clearance in many of these situations. We are getting statements. And believe me, the statements, it's not going to be a statement from Pershing or TD Ameritrade. These are exchanges. So you want to keep an eye on that. But I do think it's a business decision, Allison, as you look at your business, what you're trading, what you're recommending, what you're managing, and then what your folks are investing in. If it's a digital asset and you're managing digital assets, you want to be very careful. The world is so connected, these ecosystem DeFi networks, it's so connected. So you want to be very careful. I always err on the side of caution. That's kind of where I'm at. But again, it's something that you have to look at and look at all the risks and figure out how it fits into your business model. I kind of see a mix out there what firms are doing.
I couldn't agree with you more. I think test the waters as far as what your risk tolerance is as a corporation and what products you're offering. And also, continue to stay abreast of regulatory guidance in the area. obviously in the short time that we've had to talk about this, John, we've identified that investing in cryptocurrency and digital assets is, as an emerging asset class, is going to impact your compliance program.
Oh.
The regulatory guidance is evolving. We've only touched on a few things that you need to consider. No doubt we'll be back for part 2 of a podcast on digital investing. There are core aspects of a compliance program that you just have to consider: record keeping, fiduciary responsibilities, policies and procedures. But I think the most important thing is to just stay apprised of regulatory developments and take your guidance from either rulemaking or risk alerts or no action letters and even enforcement actions.
This has been another episode of Coffee and Regs, a CSS RegTech podcast series. Make sure you catch every episode by subscribing to our podcast on www.cssregtech.com or through your podcast platform of choice. Thanks so much for tuning in. This podcast is brought to you by Compliance Solutions Strategies and is for general information purposes only. All rights reserved.